Hello, in this video I'll be going through how to recognize revenue on long-term contracts, whether using the percentage of completion method or the completed contract method. This is the second part of a series of videos about long-term contracts. So if you haven't seen the first part, you will need to do that because I'm just going to dive into the example we were working on with part one and going through the income statement portion of it. When we went through the first video, we went through the balance sheet section of how to account for a long-term contract and whether you have the percentage, whether you're using the percentage of completion method or the completed contract method, the balance sheet section is exactly the same. When you're looking specifically only at the balance sheet entries. So when you're doing the income statement or the revenue entries, they do differ between the percentage of completion and completed contract. But when you're doing strictly the balance sheet entries that we did in the first videos, then the two methods are exactly the same. The income statement varies a little bit, but we're going to go through the percentage of completion method first, and then we'll get to the completed contract, which is only slightly different and a lot easier than the percentage of completion method. But let's just start right here where we have all of our information that we're given in the problem, which is basically that we have a long-term contract that we're building a building over a 3-year term, and we are getting paid $500,000 for it for the entire contract. So let's go through the income statement using the percentage of completion method, which means that the company will be recognized revenue over the 3-year period as it completes as it incurs costs to complete that project. But this is the information we're given in the problem. We're given the contract price is $500,000. We're given the cost incurred during each year. So this is the cost that the company incurs each year to build this building. We're given the estimated cost to complete that building, what the company thinks it will take, and the billings to customers during the year and the cash receipts, but these are really only applicable to the balance sheet side. So for purposes of this video, we're not going to be focused on those items at all. And just like it says, the percentage of completion is we are going to recognize a portion of our revenue for the contract based on the costs that we have incurred over the estimated cost that we think we will incur for the entire project. So let's just dive back into our example and see how we calculate that. The contract price is $500,000. The problem tells us the cost we have to date, right, is $150,000 year one. So right now we're going to go through 20x1, and the cost incurred for 20x1 is $150,000, which is the total cost to date, year one. The estimated cost to complete this project when the company does it in year one, the company thinks that they will have $225,000 of estimated cost to complete in addition to the cost that they've already incurred. So the total, right here, row 7, the total estimated cost is $375,000, and our gross profit that we project for this contract is $125,000. If you recall, gross profit is sales minus the cost of sales, right? Will give you your gross profit. Oops. So, sorry. So if you take the sales price of the contract price of $500,000 minus the total cost that we expect to incur, $375,000 will give us gross profit of $125,000. So based on these numbers, when you take the total cost to date, the actual cost, divided by the estimated cost, what we think the total estimated cost for this project will be, we get in year one that we are 40% complete with this project, at least for revenue recognition purposes. That's how you recognize the percentage. And this is what we're going to do. We're going to, in 20x1, so I'm right here, I'm going to look at my revenues, right? This is the amount of revenues I'm going to recognize in end of year one is my total contract price of $500,000 times my percent that my percent complete, which gives me $200,000 of revenue. My actual cost that I've incurred in the current year is actually $150,000. The problem tells me that. And so my gross profit for year one is $50,000. Okay, I'm going to ignore this part of it for year one because year one, this whole section doesn't really apply. Let's go through and see how we're going to record these entries. And we're going to go right here, like row 14. To recognize the revenue and profits, what we're going to do is we are going to, the $200,000 from right here, we're going to credit revenue from long-term contract. That is going to go on my income statement. And then we're going, for the actual cost that we've incurred during the year, we're going to debit cost of construction for $150,000. That again is going to go on my income statement. So when you look at the income statement, we're going to have $200,000 of revenue less $150,000 cost, which gives us gross profit of $50,000 on the current year income statement. That is different than this estimated gross profit that we had for $125,000 right here. This estimated gross profit is for the entire project. This right here is for the current year only. Okay, I just want to kind of point that out so no one's confused by that. So if we have a debit of 150 and a credit for 200, our journal entry obviously does not balance. And what we're going to do is we are going to debit construction in process CIP account. This is a new account. It's an asset account. It works like the inventory account for the project. And whatever your current year gross profit is, you're going to record that in this construction process account. Now I'm going to go through the T accounts because they're very important to come into place. So we're kind of going to go all over here. So you should be familiar with these T accounts if you watched the first video. And we have our construction and process account, which is what we just talked about. We also have this contra asset account to the construction and process account called billings on construction contract. And these are, as we bill the customer and we record our accounts receivable, we credit this account as we go along. And you'll see why. When we record on the balance sheet, we're going to net our construction and process account with the billings on construction contract. So we saw from the first video that when we incur the cost to construction, we also record it to this account. So we would debit this construction and process account and credit cash, or whichever way we actually paid for those costs. And now in this video, we see this other debit, this 2001 X1 gross profit. So I'm going to just go back up right here just so you can see it again right in here where we debited the $50,000. And so our ending balance at 12/31 X1 for the construction process is $200,000. Our ending balance in the billing on construction contract at the end of 2000 X1 is $120,000. We're going to take those two accounts, the ending balance, and on the 20X1 balance sheet, I'm going to have construction in process in excess of billing for $80,000. It's under a current asset. I'm also going to have the accounts receivable that I booked, and this number comes from the balance sheet entries that we booked in the first video that's in this tab. So if you want to see that, you can go back to that previous video. Now I'm going to go to my year 2, 20X2, and this is the information that we were provided in the book. The contract price is $500,000. Our cost incurred during the year is $100,000 and our estimated cost to complete is $150,000. Remember, these two items are just for the balance sheet, so we're not going to use them here. So let's figure out our percent of completion to recognize during the year. What percent of revenue can we recognize from the $500,000? The way we do our calculate our percent is we're going to take our cost to date. Now notice when we're going here, this is the information that we were provided with in the problem. It says costs incurred during the year. So in year one, we incurred $150,000. Year two, we incurred $100,000. So that means our cost to date is total cost that we've incurred is going to be the $150,000 plus the $100,000, which is why our cost to date is $250,000. And our estimated cost to complete is $150,000. We have $150,000 more cost that we expect to incur in order to complete this contract. And so then our estimated total cost is going to be the $400,000. The ones that we've incurred to date plus the ones that we estimate we're still going to incur. And that would give us an estimated gross profit for this contract for $100,000, which is the contract price of $500 minus our estimated total cost of $400,000. Now let's calculate the percent that we're going to recognize for revenue for the. And the way we do that is we take our total costs that we've incurred to date divided by our estimated total cost. So we're going to take the $250,000 divided by $400,000 gives me 62.5%. And that's the revenue that I'm going to apply to calculate how much I'm going to recognize. Okay, so let's just go down here. I'm down here on 2002 of how much revenue and costs we're going to record in the current year. Well, so far it says that the contract price is $500,000 and the percentage that we can recognize 62.5% of those revenues. This means that we should be able to recognize 62.5% of those revenues for the entirety of the contract as of the end of the second year. So when you take the first year revenues plus your second year, it can equal 62.5% of the total contract price of $500,000. So how do we calculate that? We're going to take our revenues of $500,000 times 62.5% gives me the $312,500. My cost that I'm incurred to date, right? This whole column is everything is to date means for the entirety of the contract through to date. So my cost to date is the $250,000, which remember is my $150,000 from year one plus my $100,000 from year two. And it gives me a gross profit to date of $62,500. So what am I going to recognize though in this year, right? Because I've already recognized a portion of this last year, and this is where this comes in. You have to remove the portion that you've already recognized in previous years. So I've already recognized $200,000 of revenue in year one, 20x1, and I've recognized $150,000 of cost in year one. So when I subtract that, if you look at this formula right here, it gives me that this formula is taking the revenues to date, the $312,000 minus the revenues I've already recognized. So this will give me my revenues that I should record in the current year. And I'm going to do the same thing with costs. My year-to-date costs minus my costs that I've already previously recorded. So my current year cost to recognize this year is $100,000, and which makes my gross profit just for the current year is $12,500. So now I'm going to go to my journal entries, and I've made this a little smaller just so it all fits into the screen. So I apologize if it's really small, but this is where we were. This is what we've just calculated for 20x2 to be recognized in the current year. So I'm going to recognize the revenue for $112,500. So I'm going to credit right here revenue from long-term contract for $112,500. I'm going to record my cost for the current year, which is $100,000. So I'm going to debit this cost of construction for $100,000. That goes on my income statement. And the gross profit, or really the plug, is going to be a debit to my asset account called construction in process for $12,500. Okay, now I'm going to go back down to my T accounts just so you can see here the construction in process where I have I started at 12/31/X1. I had a balance of $200,000. I recorded my 2000 X2 construction cost to this account back when we did the balance sheet side of things. And now I've just recorded my 2000 X2 gross profit amount, which was a debit of $12,500. So my ending balance here in my construction process at 12/31/X2 is $312,500. So then when I go to do my balance sheet, I'm going to look at, I'm going to look at my construction in process account at 12/31/X2 of $312,000, and I'm going to net it with my billings on construction contract, which is $320,000, and I'm going to get to a net credit amount for $7,500. So in 20X2, when I do my balance sheet under my current liabilities, now I'm going to have billings in excess of construction in process for $7,500. I also have to record my accounts receivable for all the amounts that I've recorded in accounts receivable, less everything that I've collected, which was $80,000, again, from the balance sheet side of the equation. Now let's go to our third and final year in the contract, which is right here, 20X3. The contract is $500,000. The cost I've incurred during the year is $160,000. Okay, so now, and that comes from right here. This is where I'm looking at. Now I'm going to go to right in here, this right here, 20X3, to figure out all the pieces of information. My contract is $500,000. My cost to date is $410,000. Okay, so I'm going to go back into my information that was given in the problem. The cost incurred during the year. I've incurred $150,000 in year 1, $100,000 in year 2, and $160,000 in year 3. When you add those all up, my total cost to date is $410,000. Notice my estimated cost to complete is 0 because this is the end of my contract. I shouldn't have any more estimated cost to complete, right? So my cost to date and my estimated total cost are the same, and therefore my percent is 100% complete, which makes sense since this is a 3-year project. I've also updated my overall gross profit for this project to be $90,000. It's the $500,000 contract price less my total cost that actually incurred is $410,000, gives me $90,000 gross profit. So just want you to notice the gross profit has changed year over year as the costs, our estimated cost versus our final cost changed year over year. Now let's go through our final year right here and see what we need to record as our revenues and costs. So in our final year, the cumulative revenue that we should be recognized for revenue over the course of this entire contract is of $500,000. So we're just going to take the 500,000 times 100%. Our cost to date, our total overall cost is $410,000, gives me overall gross profit of $90,000. But I've already recorded a portion of that, so I have to remove from these totals the portion that we've already recorded in prior years. So I already recorded $312,000 in prior years, and that comes from right here, right from above. And I've already recorded $250,000 of cost, which gives me then the current year, you take the $500,000 minus the $312,500, I'm going to recognize $187,500 of revenue this year and $160,000 of costs. And again, I'm going to record the exact same thing right here. I'm gonna credit my revenue from long-term contracts for $187,500, debit my cost of construction for $160,000, and I'm gonna debit my construction process for $27,500. let's go down to my T account and see what I'm going to record. Here's my construction in process. My $160,000 was the cost I've incurred to date, which cost I incurred in the current year, which I recorded in the balance sheet video. And then my current year, my 20x3 gross profit of a debit of $27,500. Now I want you to see here, when you look at your total for your subtotal for 20x3 at the end of the year, my construction process is $500,000, and my billings on construction contract is also $500,000. Those two should be the same at the end of the contract. Okay, so then in order to close those accounts out, at the very last entry we do at the end of the contract is we close those accounts out. So construction process should have a balance, debit balance. So I'm going to credit that account by $500,000, and my billings on construction should have a credit balance. So I'm going to debit that account to zero it out. So my final entry here is, oops, it got removed somehow, is right here. This is my final entry, my debit for billings on construction, and my credit to construction in process. Now let's go through the income statement side for the completed contract, which is a lot simpler. So we have to recognize the full $500,000 in the year that the contract ends, and we're going to recognize the $410,000 of costs that we've incurred to date on the income statement. We have been recording this $400,000, this $410,000 in our construction in progress account. And I apologize, I've been kept saying construction in process. It's construction in progress. So, and we're going to recognize $90,000 of gross profit, and because 100% of our project is now complete. So you have nothing 20x1, no entries in 20x2, and you're going to recognize the full $500,000 in 20x3. So revenue from long-term contract is the credit $500,000, debit cost of construction $410,000 for the actual costs you've incurred for the entire contract, and debit construction in progress account for $90,000. Okay, and so when we look at our T accounts and we record all those at the end of 12/31/X2, our balances were $250,000 and $320,000 respectively. We recorded our construction cost to the construction in progress account for $160,000 back from the balance sheet video. And now we're going to record a debit to construction in progress for the 20x3 gross profit amount of $90,000. So you'll notice here that our subtotals are once again $500,000 debit in the construction in progress and $500,000 credit in the billings on construction contract, which is exactly what it was in the percentage of completion method when we went down here. I'm looking at row 43 here, right here. So, and then we have the same entry as the percentage of completion method to close out these accounts. We're going to credit the construction in progress for $500 and debit billings on construction for $500,000. So, and that's going to be this entry right here. So you can see that the completed contract is a lot simpler, but which is why I went over it at the end.